I remember sitting in a quiet corner of my apartment back in 2020. I had just graduated and the world felt like it was shifting under my feet. At that time, I thought I had it all figured out. I believed that if I just worked hard and followed the classic advice, I would be fine. The advice we all heard from our parents was simple: buy good companies and hold them forever. They told us to plant an oak tree and wait 30 years for the shade. But the market has a very distinct way of humbling you just when you think you have mastered the game. I remember looking at my first brokerage account and feeling like a genius because everything was green. In reality, I was just a passenger on a massive wave I did not even understand. It took me a few years of being pushed around by the market to realize a very boring truth. The hardest part of investing is not finding a good company. The hardest part is realizing when the story everyone tells about that company is no longer true. I am 26 years old now and I managed to save my first $100,000 not through luck, but through discipline. I stopped looking for the next moonshot and started looking at the math. I started looking at the mechanical reality of how money actually moves in the world today. I want to talk to you about something that looks like a major opportunity in software stocks. Software stocks have barely moved in 2 years, while the Nasdaq has exploded by 70%. This has created a massive gap, a mismatch that feels like a stretched rubber band. I am the guy who bought oil stocks 6 months before the conflict in the Middle East started. I did not have a crystal ball, and I am certainly not a prophet. I just saw the big money moving into energy while everyone else was looking at tech. I am up about 60% on that trade while the broader market has been relatively flat. That experience taught me that Wall Street does not care about your feelings or your long-term plans. The truth that nobody tells you is that many big players no longer buy stocks for their quality. They do not care about the management or the annual reports as much as they used to. In this era of high-frequency trading and instant information, they care about momentum. They care about where the next $1 billion is going to land. It might sound fickle or even a bit cynical to you. I know you are used to the buy and hold philosophy because it feels safe, but if you do not understand how the big money hops from bucket to bucket, you will be left behind. You might hold your favorite software stocks and make 0% while the rest of the world makes 70%. I am currently sitting in a hotel room in London and I am on the move. But I had to record this because the data is becoming too loud to ignore. I have also prepared a full research report for you at felixfriends.org/software.it is free because I want us to be on the same page when we look at these numbers. Let us look at the situation clearly and without the hype. If you had invested $10,000 in the Nasdaq in 2024, you would have $17,000 today. That is a great return by any standard, but if you put that same $10,000 into the biggest software companies, you would have about $9,000. You would actually be losing money while your friends are celebrating. How is it possible that software, which is the backbone of the modern world, is going down? The reason is a very powerful narrative that has taken over Wall Street. The narrative is that AI is going to kill all software companies. Hedge funds have bet $24 billion on this single idea this year alone. They believe AI can do what these software companies do, but better and faster. It is a scary story if you are an investor in these companies. But when everyone is standing on one side of a boat, the boat becomes incredibly unstable. The smart money creates the fear, and then they profit from it. But eventually, the boat has to tip back the other way. Investing used to be a long game of patience, but today the world moves too fast for the old rules to apply perfectly. A company that looks like a giant today can be disrupted in 18 months. This is why the pros do not marry their stocks. They follow the flow of capital. I am holding a live session this weekend called Why Buy and Hold is Dead in 2026. You can find it at buyandgrow.net, and it is entirely free. I want to show you what has replaced the old strategy your parents used. Whether you are in the US or the UK, the math remains the same. I want to teach you a framework called the rubber band effect. Think about a rubber band being pulled as far as it can go in one direction. The further you pull it, the more tension and pressure builds up inside. Eventually, the pressure becomes too much, and the rubber band snaps back. It snaps back with more force than it was pulled with in the first place. The software sector is that stretched rubber band right now. Professional investors are not guessing, they are watching for specific signs of the snap. The first step is checking the positioning of the market. This is a measure of how many people are betting up versus how many are betting down. Right now, the ratio is incredibly lopsided. Almost everyone who wanted to bet against software has already placed their bet. There is very little room for more people to join the downward trend. The second step is to look for the crack in the ceiling. This happens when a stock price breaks through a level it has been stuck under for a long time. I look at the software ETF called XSW as a primary indicator. It has been stuck around $160 for months and months. When it breaks that level, it sends a signal to the entire market. It is the first sign that the rubber band is starting to slip. The third and most powerful step is what I call forced buying. When the price starts to move up, all those hedge funds that bet against software have a problem. They start losing money on their short positions. To stop the bleeding, they are forced to buy the stocks back. They are not buying because they suddenly love the company, they are buying because they have to. And this creates a massive wave of demand. This is a mechanical reality of how markets function. It is like a stampede where everyone is trying to get through a narrow door at the same time. The simplest way to participate in this is not through picking one winner. The safest way is usually through an index fund like XSW. It gives you you exposure to over 100 different software companies. If the sector recovers, the index will rise without the risk of a single company failing. I am not a financial advisor, and I am not telling you what to do with your money. I am just sharing the research that helped me reach my goals. The fear around AI killing software is likely exaggerated in the short term. Think about it. Have you canceled your Microsoft or Adobe subscriptions lately? Probably not, because it is incredibly difficult for a company to switch its entire workflow. The cost of retraining employees is often higher than the cost of the software itself. This gives these big companies a massive moat that the market is currently ignoring. I am also looking at a few individual names like CoreWeave and Big Bear AI. CoreWeave provides the actual infrastructure that AI needs to run. They have a massive backlog of revenue because the demand for computing power is infinite. Big Bear AI works with the US government on national security and logistics. They are winning real contracts while the stock price is at a major discount. Then there is Unity Software, which is the engine for millions of games and apps. The stock has been absolutely crushed, down nearly 90% from its peak, but the gaming industry is not going away and Unity is still a dominant force. I like to look for companies that have been punished more than they deserve. That is where the math of the recovery becomes most attractive. You have to know when to sell and how to manage your position sizes. You cannot just buy a stock and hope for the best without a plan. That is why I want you to join me this weekend so we can talk about the details. I will be live from France and we will walk through the exact systems I use. The old playbook is failing because technology is moving at the speed of light. We used to look at companies like Nokia or BlackBerry as unbreakable giants. Then the world changed and those giants disappeared almost overnight. The money that was in those companies did not vanish. It just moved somewhere else. Our job as investors is to be where the money is going, not where it used to be. I want to help you build a portfolio that is resilient. And based on facts, we are not looking for a lottery ticket. We are looking for the inevitable snap of the rubber band. It takes patience to wait for these setups, and most people do not have it. They want to trade every single day because they are bored. But the real money is made in the waiting and the discipline. I spent years watching from the sidelines before I made my big moves. I made mistakes along the way, and I felt the pain of losing money. But those losses taught me more than any textbook ever could. They taught me that the market does not care about my opinion. It only cares about the supply and demand of capital. If you can learn to see the world through this lens, everything changes. You stop being a victim of the news cycles and start being a student of the numbers. I want to thank you for spending this time with me today. I know there are 1,000 other things you could be doing, but investing in your own understanding is the only thing that pays a guaranteed dividend. I hope to see you at the live session this weekend. We will dive into the charts and the data together. Remember that wealth is not about how much you make in 1 year. It is about how much you keep and how wisely you deploy it. Be patient with yourself and stay focused on the long-term math. The noise of the world is loud, but the truth is usually very quiet. It is found in the spreadsheets and the historical cycles of the market. I will continue to share what I find as I navigate this journey myself. We are all in this together, trying to make sense of a very complex world. I wish you nothing but the best on your own path to financial freedom. It is a marathon, not a sprint, and I am glad to be running it with you. I am going to get some rest. Now, before my next flight, take care of yourself and your investments. I will see you in the next video or at the seminar on Saturday. Peace.